So are the details behind the stock market's recent volatility? It's all about the yield curve. Julia Chatterley explains what that curve is, what an inversion means, and why this all matters.
All the major US stock markets fell in Wednesday's session because something specific spooked investors. Specifically, we saw an inversion of the yield curve. That's seen as a warning sign that's had an eerily accurate track record for predicting future recessions. So the question is, what is a yield curve inversion and why does it matter? Well, in plain terms, during an inversion, investors get paid better interest rates to lend money for a shorter period of time than a longer one. That's clearly not normal. Usually longer-term bonds are considered riskier, your money's at risk for longer, and therefore pay lenders better interest rates than shorter-term ones. Now, when the yield curve inverted, 2-year bonds paid better than 10-year ones. As you can see, it was slight, but it matters. Now, investors are nervous about the state of the economy for a whole host of reasons. We've got the trade war between the United States and China that keeps escalating. Germany's economy now, Europe's largest, is shrinking, and there are worries that China's slowdown could also get worse here. Now, throughout the year, investors have been putting money into government bonds as a flight to safety mechanism because unlike stocks, the returns are pretty much guaranteed for bonds. The problem is the more they buy, the lower the yield goes. And investors are now seeking safety in bonds, even though they're getting a minuscule rate of return. The 30-year rate here in the United States is now also at a record low. So here's the larger concern, though, and why it's causing a sell-off in stock markets. The last 5 times there's been an inversion like this, it's been followed by a recession. You can see this highlighted in yellow. Yield curve inversion, recession. Same here. Inversion, recession. The problem here is, though, the recession doesn't always come right away. It can be many months or even years, traditionally around 12 to 18 months later. Now, some economists argue this time could be different. Maybe the prophecy of the inverted yield curve won't come true. It's also not always the case that we get this warning sign in the bond market and then see a US recession. It doesn't always happen. But markets right now are looking to the past record as a recession predictor, and they're deciding to sell. Julia Chatterley, CNN, New York.